Welcome back to the deep dive. We're here to really unpack the big forces shaping things and distill them down for you. Today we're jumping into the, well, let's face it, often confusing world of volatile stocks, and our main focus, Tesla. Just picture this. A stock market that's less like a gentle stream and more like, I don't know, whitewater rapids. I mean, we're talking about a stock, TSLA, that surged, over 20% just this past May?
Yeah, incredible jump.
But then it also faced some serious pressure late last year and early this year. And this isn't new for Tesla, right?
Not at all. It's kind of its signature move.
Its history is wild. You see prices from, way back in the 20s, $70, and then more recently bouncing around $187, $261, hitting a peak near $479 and swings down to like $351, $362, $284. It's just extreme dynamism.
Absolutely defines it.
Okay, so let's unpack this a bit. Our mission for this deep dive is really to explore how sophisticated intelligence can maybe give you an edge. That edge often gets called alpha in these super dynamic markets.
Right.
Think of it as a way to cut through the noise, get some clarity on, the cutting edge of investment thinking.
And what's really fascinating here, I think, is how a stock like Tesla makes such a perfect case study. It lets us demonstrate the power of what we're calling quant intelligence. In fact, this deep dive is kind of launching our new Alpha Stock series.
Oh, interesting.
Yeah, the whole idea is to uncover how these advanced models actually spot patterns, how they connect the dots in all this complex, fast-moving data. It gives you a really critical perspective, helps you understand market dynamics better, especially when the stakes are this high.
Makes sense. So maybe let's start with Tesla's journey itself, because it's not just cars anymore, is it? It's like this global thing.
Definitely not just cars.
Founded back in 2003, moved pretty quick from that initial Roadster to the Model 3. Even went through what Musk himself called production hell. Remember that?
Oh, yeah. Vividly. That was a challenging period.
And since then, the Cybertruck reveal, getting into the S&P 500, they just keep pushing, right? Next-gen platforms, superchargers, full self-driving.
Relentlessly ambitious.
And it's that ambition mixed with, real-world hurdles that seems to drive its market behavior.
Exactly. And that brings us right to why Tesla is so volatile. It really is this unique blend of visionary leadership and, well, some very distinct challenges. Mm-hmm. At the heart of it, you've got Elon Musk, his leadership. Visionary, ambitious, no doubt. Often unconventional, too.
That's putting it mildly sometimes.
Yeah. So the strengths are obvious. Really groundbreaking innovation in EVs, batteries, autonomous driving. He's built this incredibly powerful brand, fiercely loyal customers. And the company itself can be remarkably agile. They execute, they iterate constantly.
But there's another side to that coin, isn't there?
There absolutely is. Those strengths come with big challenges. Musk's bandwidth, for one, is constantly questioned. He's juggling SpaceX, XAI, X-Twitter, Neuralink. It's a lot.
A huge amount.
And his communication style, especially on social media, can be unpredictable. It directly impacts the stock sometimes, introduces volatility.
Yeah, the infamous tweets.
Mm-hmm. Plus, there's a history of really aggressive timelines, FSD, Cybertruck.
Right.
They often get missed. And then you have concerns about succession planning, given how central he is. And all this is happening while market share pressure is just ramping up. Competition is fierce.
Let's talk about that competition in the products, too, because it's way beyond just the cars now.
Oh, absolutely. The product breadth is huge. You've got the Model S, 3XY, the Cybertruck starting to scale, the Roadster and Semi hopefully coming. But then there's the whole autonomous driving piece with FSD Beta. Big focus there.
And energy side, too, right?
Yeah.
Powerwall, Megapack.
Exactly. Powerwall for homes, Megapack for utilities, solar roof, solar panels, and critically the supercharger network.
Yeah.
That's still a massive competitive advantage, almost like a moat.
Okay, but who are they actually up against in all these areas?
Well, the competition is intense, and it's everywhere. In EVs, you've got the legacy guys, Ford, GM, VW, Hyundai, Kia, Mercedes, BMW, all pouring billions in.
Right.
You've got the Chinese EV makers, very agile. BYD, which actually outsold Tesla globally for a bit.
Yeah, saw that.
NIO, Li Auto, XPeng. Plus other EV startups like Rivian and Lucid finding their niches. And it doesn't stop there. Autonomous driving, they're up against giants like Waymo, Cruise, energy storage, big players like LG Chem, Panasonic. It's crowded.
Wow. Okay, so putting it all together, what does this mean for someone just trying to follow this or maybe thinking about investing? Tesla's clearly pushing boundaries, no question. But it's also facing immense pressure and these internal quirks.
Exactly.
It's that mix that makes the stock performance so, dramatic, like we said. You can't ignore it, but trying to predict it with old methods seems tough.
Incredibly tough. And that raises the key question, right? How do investors even begin to make sense of all these moving parts, all these market forces swirling around? For a stock this complex, the traditional read the news, check the fundamentals approach, it often falls short. There's just too much noise, too many variables changing too fast.
Okay.
And this is precisely where these sophisticated intelligence models start to look really valuable. They offer a potential way through all that complexity.
Right. And this leads us nicely into the core idea for today, alpha. If you're navigating these kinds of choppy waters, you want an edge, don't you? In finance, that's alpha, basically, the ability to beat the market, to do better than just buying and holding. And what we're going to dig into now is how some cutting-edge systems are actually designed to generate that alpha, even when things get really wild. This is where it gets really interesting, I think. We're looking at how quantitative trading models, built with what we're calling alpha intelligence, try to handle these notoriously tricky markets.
Exactly.
And our sources gave us this really insightful chart, didn't they? TSLA performance, alpha intelligence versus buy and hold. It lays it out pretty clearly.
It does, yeah. It's quite compelling. This chart covers a specific period from mid-July 2024 to early June 2025. And it compares two main intelligence models against just, buying and holding the stock. These aren't simple systems. They're advanced algorithmic and machine learning approaches.
Okay, so what are the two models?
Well, the first one is a pure algorithmic approach. Let's call it the algorithmic intelligence model, or ROI in the chart. This one basically operates on a complex set of predefined rules, statistical analysis. It reacts to market signals with machine-like precision.
Got it. Pure algorithm.
Then the second one, IMROI, that's an ML-enhanced model, ML meaning machine learning. This one adds an intelligent risk mitigation layer.
Ah, okay, so it's learning.
Exactly. It uses AI to learn from historical data, constantly tweaking its strategy. And crucially, it has that built-in intelligent risk management piece. And both of these are benchmarked against the simple buy and hold strategy, the BHROI.
So if the first one, the algorithmic one, is mostly following strict rules, does that mean the ML one, the MROI, can actually learn and maybe adapt its risk strategy on the fly, like maybe pull back if things look too dicey?
That's precisely the idea. The ML model analyzes vast amounts of data, looking for patterns that might signal a shift in market risk. And that intelligent risk mitigation, it means it might do things like dynamically adjust its position size, maybe reduce exposure if uncertainty spikes.
Okay.
Or it might even exit trades temporarily if certain risk triggers are hit, like, say, a sudden drop in market liquidity or a big jump in volatility. The goal is to protect capital while still looking for those opportunities.
Yeah.
It aims for a potentially smoother ride, maybe a less bumpy equity curve.
Right, makes sense. And the results, the actual performance shown in the data.
They're pretty remarkable.
Let's walk through the ROI, the return on investment, for that period. If you just bought Tesla and held it the buy and hold strategy, BHROI, you'd have made a modest 27.09% return.
Decent, but modest in this context.
Now compare that. The ML enhanced model, MROI, delivered a really robust 182.84% ROI.
A huge difference.
And the pure algorithmic intelligence model ROI, even higher, 192.89% ROI.
Just slightly edging out the ML model.
Just think about that gap for a moment. Both advanced models beat buy and hold by more than 7 times.
Yeah, the magnitude is striking.
It really highlights the potential advantage these sophisticated algorithms can offer, doesn't it? Especially with something as jumpy as TSLA.
It really does. And if we connect this back to the bigger picture, that slight difference between the two advanced models is actually quite telling. Like you noted, the pure algorithmic intelligence model slightly outperformed the MLROI one.
Yeah, only by a few percent, but still higher. So if the ML1 is supposed to be learning and managing risk, does that mean its caution sometimes holds it back a tiny bit compared to the more aggressive algo? Is that trade-off always desirable?
That's a really insightful question. And yes, you're hitting on a key point. That slight underperformance is likely down to exactly that. The ML model's more conservative stance due to its intelligent risk mitigation. While that ML layer is designed to reduce risk, smooth out the ride, avoid big drawdowns, that strategic conservatism can sometimes mean slightly lower overall returns.
Especially in a strong bull run, maybe.
Exactly, especially in strongly trending markets, where just taking on more risk might actually yield higher gains, although potentially much more volatile gains too.
Okay.
So it really represents a trade-off. The ML model prioritizes, let's say, capital preservation, or achieving smoother equity curves. That might appeal more to investors who value stability, even if it means missing out on that last fraction of extreme upside potential.
Gotcha. It's about risk appetite then.
Precisely.
And the chart had more detail too, right? Below the main ROI lines?
It did, yeah. There were other panes adding context.
Like the middle one, the incremental ROI, AMROI. That showed the period-by-period returns, didn't it?
Correct. It gave a visual breakdown. You could see how both models often caught gains during similar upward moves, but maybe handled the wiggles slightly differently along the way.
And then the bottom pane, that looked really interesting. Price, volume, trade signals.
Yeah, that's where you really see the volatility in action. It vividly showed TSLA's price bouncing around within that time frame, roughly from $200 up towards $400.
Which, as we discussed, is classic Tesla behavior. Those swings are just part of its DNA.
Absolutely. And you also see the volume bars on that pane, green showing buying pressure, red showing selling.
And those little white triangles on the price line, those were the trades?
Those are the trade signals, yes.
Uh-huh.
Upward triangle for a buy signal, downward for a sell. And their timing, where they appear on those price swings, it suggests the models were pretty adept at finding opportune moments to get in and out.
So it's not just about the final big number. It's seeing how these systems navigate the messiness day to day, cutting through the noise to try and capitalize on those swings.
That's the essence of it. This analysis really confirms that for a stock as volatile as TSLA, these kinds of sophisticated intelligence models can be, well, critical tools. Tools for navigating the chaos and potentially maximizing returns. But importantly, it's not just about Tesla. This same principle applies to any highly dynamic asset where traditional methods might struggle.
Right. The principles are broader.
Yeah. And knowledge like this is most valuable when you understand it and can see its application. This data-driven approach offers a powerful way to distill crucial insights from what can feel like an overwhelming flood of information.
But these models, they can feel a bit like black boxes, can't they? Making trades based on algorithms we don't fully see. How do you address that concern? The lack of human transparency in the decision itself.
That's a really fair point, and it highlights a key distinction. While the internal computations of, say, a complex AI model might not be easily interpretable by a human in real time, the results are transparent. We see the trades, we see the performance. And the underlying logic isn't random. It's built on quantifiable market dynamics, statistical patterns, probabilities. It's less about trusting gut feeling and more about trusting a robust methodology that's been statistically validated.
So it's a different kind of trust.
Exactly. These models are designed to thrive precisely in situations where human analysis often struggles dealing with massive data sets, avoiding emotional biases. Think about analyst sentiment on Tesla itself. It's all over the place, right? Widely varying price targets. You've got strong bull cases, next-gen platforms, FSD finally happening, energy growth. And equally strong bear cases, competition heating up, maybe slowing EV demand, FSD delays again, CEO distractions, valuation concerns. It's this incredibly complex, often contradictory landscape that these models try to navigate by focusing on the patterns in the data, not the narratives.
Right, cutting through the conflicting stories. That makes sense. For this deep dive into alpha intelligence, it really gives you a glimpse into how cutting-edge tech is helping us make sense of these incredibly complex, fast-moving markets. It's about finding clarity, finding a potential advantage, getting those aha moments without feeling totally buried by data overload. So I think the core takeaway today is pretty clear. There can be a significant advantage offered by sophisticated quantitative intelligence models, especially when markets get volatile like they do with Tesla.
Definitely. They're not just riding the roller coaster. They're built to try and master it. And this whole deep dive into alpha intelligence in action really raises an important question for you to think about. In a world that's just getting swamped with more data, more complexity, where does the future of successful investing lie? Is it more about human intuition? Or will it belong more to the cold, precise calculations of machine intelligence? Or maybe. Perhaps it's some kind of synergistic blend of both, something to ponder.